Greetings, campers, and welcome to our webinar today, part 3 of our series on artistic legacy preparation, which we also call A Place to Leave Your Stuff. My name is Scott Walker. I'm the Executive Director of the Canadian Artists Network, formerly known as CSARN, and it is a pleasure to welcome you here today. In fact, it's a pleasure to welcome artists from right across and around North America. We have registrants from Happy Valley Goose Bay in Labrador, Gabriola Island in BC, and down in Dallas, Texas. So welcome to all of you. I'd like to begin by acknowledging that we live, work, and create on the traditional territories of Indigenous peoples. We've cared for this land, now called Canada, since time immemorial. We acknowledge this as part of our covenant with all Indigenous nations to share, respect, and protect the land in the spirit of peace and friendship, and to honor the future generations of all of our nations. This, as I say, is the third in our series of webinars. Before we get started, though, I would like to break for a little commercial, and that is to talk about another upcoming event that you may know about, but I'd like to make sure you know about it, and that is our annual conference, Maintaining Creativity 8. The overall theme, as you can see, is Artists as Agents of Change, and it is taking place the week of October 30th. October 30th, a Monday, Wednesday, November 1st, and Friday, November 3rd. Each session, each chapter will last for 2 hours, and that will include breakout sessions where you have a chance to talk about things. Let me give you an idea of what's happening on the 30th. The first chapter is Women Warriors for Change, and as you can see, we have a great lineup of dynamic women to talk about this issue. Now, we haven't completely filled out the panel for chapters 2 and 3, but I can give you an idea of what's going to happen. On November 1st, again at 1 p.m. Eastern Time, we will present another panel called Inclusion, Where Are We? And the moderator of that panel will be Stephen Loft, who is the recently appointed Vice President of Indigenous Ways and Decolonization at the National Gallery of Canada. And then on Friday, the 3rd of November, we will present the original gig workers, strategies towards economic stability. And the panel, or the moderator for that panel, will be Gary Neal, who is, to begin with, the chair of the board of the Canadian Artists Network, was my predecessor as executive director of this organization, and is a longtime cultural policy expert. So we hope you will sign up for all 3 of those chapters. You can do so online on our website. We're still using our old website, which is csarn.ca. So today we're going to focus on the financial aspects of preparing your artistic legacy. Now, as you recall, when you registered, you were asked if you had any questions for today's presenter. And we had several questions about wills and copyright and archiving. Now, we're not going to be talking about those today because they were covered in the first 2 sessions of this series on artistic legacy. So if you missed them, no problem. You can find the videos of the entire sessions, again, on our website, csarn.ca, and just click on the webinars tab, and you'll be able to go straight to it, and you can watch the entire presentation. For those of you who did submit questions about today's topic, we'll get to as many of them as possible. Questions may also occur to you as you're listening to our expert. What you can do is put those in the chat box. The only thing we ask, because people tend to comment and chat back and forth, which is what the chat box is for, of course. But if you're going to ask a question of Zoe Klein, please put a question mark at the start of your question and at the end of your question as well. But if you put it at the start of the question, I'll be able to identify it as a question for our presenter. And please keep your questions as brief as possible, too. So let's get to it. Today's presenter is one of us. She's been doing what she does for close to 4 decades, helping artists sort out their taxes. Please welcome Zoe Klein. Zoe, great to have you here.
Thank you so much, Scott. I always feel a little uncomfortable being called an expert, but I must be expert at something to have been doing it for this long.
Well, compared to the rest of us, Zoe,
Okay.
I'll leave you to it, but I'll be around in case anybody needs me.
Okay, thank you. So today we're going to talk about income tax matters as they affect people on their death and after they die. And while I realize that some of this is reiterating what Scott said, while I realize that some of these things touch on legal matters, I'll only address them where there's a direct interaction, because I'm definitely not an expert on legal matters, nor on copyright or what can and cannot go into a will. I thought I would start with the simple things about what the steps are, what happens when somebody dies. And this is true for everybody, not just artists. And then we'll move on to the specific things that affect people in the arts. So when somebody dies, in the year that they die, there's a tax return required called the final tax return. And that return goes from the first of the year up to the date of death. And it is just like any tax return you would ever file, includes whatever income you have in the year up until the date of death. The only difference between that and a regular tax return is that it's a shorter year, typically, unless you happen to die on December 31st. In which case it would be exactly like all your other tax returns. The filing date for that tax return is April 30th of the following year or 6 months after the date of death, whichever is later. There may and often is a need to file another tax return called an estate return, and that return would encompass only income earned after death. And I'll just interject myself. There is a possibility, although it's not often that we do it, to file an additional return called a return of rights and things. Rights and things are income that's earned prior to death, but is received after death. So it's not yet, this is income earned by an individual, not yet an estate. So it's kind of in limbo between the final return and the estate return. I mention it specifically as affects artists because artists have, at least visual artists and sculptors and potters and the like, have sometimes inventory on hand that could be sold in that period after death before an estate is formed. So there may be a need to file that type of a tax return. Something else that's common. After a person dies, typically their family or executor will apply for the CPP death benefit. That's the usually $2,500 check that goes to whoever applies for it. And the people who can apply are immediate family or the executor. That income has to go either on an estate return or on the return of the person who actually received the money. It cannot be reported on the deceased person's return. So usually it does go on an estate return, although occasionally when if there's a married couple and one dies and they have an estate set up whereby everything is being inherited by the surviving spouse, sometimes they'll avoid having to do an estate return after the death of the first spouse, and the surviving spouse will simply report that income. And this leads me to the next comment, which is when would we want to create an estate? So an estate is a legal entity, just like a person is, but it's a legal entity that exists after a person dies. Sometimes people use the terms trust and estate interchangeably, and they are sometimes interchangeable. At least in an estate files a trust tax return, but a trust can also be something, a separate legal entity for a living person, and an estate can only be a separate legal entity that encompasses the income and assets of a deceased person. So most people have an estate unless they actually literally die with no money and no surviving spouse to take that CPP death benefit. Most of us have to have an estate. Some of our estates are simpler, some more complex. The main thing I want to say about estates is that when somebody has a more or less complex estate, you need to be aware that the type of estate that's created when a person dies, there's 3 years during which time that estate will be taxed at the same rate that the person would have been taxed at during their lifetime. So whatever income is earned, no matter what that income is, will be taxed at the same personal tax rate as the individual when they were alive. Once the 3 years is up, that estate will pay tax at the highest rate. So there's an understanding that one would want to typically wind up an estate within 3 years. The reason somebody might have an estate that lasts longer than that would depend on what the will that dictates how the estate should be run says. So if you have if the will states that the estate should run longer because, let's say, there are minor children, and or even not minor children, but they want the money paid out to the beneficiaries over a period of time that exceeds the 3 years, then that's what you have to do. And you need to be both the executor or manager of the estate and the person in their lifetime needs to understand that it's okay to do that, but your estate will also pay a higher rate of tax as a result of it running longer than 3 years. Someone asked how you find a person to manage your estate, and that's kind of the $6 million question. Most people choose as their executors, or I shouldn't say most, many people choose as their executors a child or children, or they'll choose a spouse as long as the spouse is living, and then if the spouse isn't living, then a child will take over. That works if your child is willing to do that, if you trust them to handle your affairs properly, and if there is a child. People who don't have kids or don't have kids they wish to trust often choose a friend or relative. And those, I know 2 people right now who are using the estate department of a bank to manage their affairs after they're gone. And some people use estate lawyers to manage their affairs. It can be hard. It's a hard job to be an executor. It's less difficult when it's spouses and one dies, but when the second spouse dies or where there isn't a spouse, being an executor is a lot of work and a lot of responsibility. I know this professionally because I work with lots of people who have been executors. And I know it personally because my own husband died 6 years ago, and I was the executor for that estate. And it's a lot of work. The estates are governed by provincial law. So if you live and die in a particular province, the rules that govern your estate will be governed by the province. In Ontario, executors can charge an estate an executor fee. Often family members do not do this because they figure it's just their own money they'll be inheriting anyways. But where it's a bank, let's say, or a lawyer, or somebody outside the family, often they will charge an executor fee. And really it's kind of, they set a percentage, I think it's 5% of the value of the estate. And honestly, typically, especially if they do a good job, they earn that money. And they are also taxed on that money. So the executor would need to know that if they're going to take a fee, they actually have to create a payroll account. The estate has to pay the payroll taxes on that executor fee and issue a T4 slip to the executor. As you probably know, beneficiaries are not taxed on inheritance. So in Ontario and in Canada, inheritance itself is not taxable. This is why a spouse, let's say, or a child wouldn't typically charge an executor fee, because they could just take the money as a beneficiary without having to pay tax on it. So there were a number of questions that encompassed giving things away after a death, whether things held in corporations, etc. So I thought I'd talk around those types of issues. So we'll start by saying there are a number of different legal entities: corporations, individuals, partnerships, estates, and charities. And there are different types of charities. There are charities that issue tax receipts. There are foundations. Foundations are charities that only give money to other charities. At least one person who wrote in wondered what happened in a corporation, what happened to the work held in a corporation. So the answer to that is that you need a good corporate lawyer, because if you have a corporation and all of your works, whether those are manuscripts or paintings, or racehorses for that matter, if everything is held in a corporation, you as an individual do not own those works, the corporation does. What you own is shares in a corporation. This may be one way that people want to look at estate planning, because your will could simply bequeath the shares in that corporation to an individual or family member. And then it's up, and most corporations have a plan written out about what, especially if there's more than one owner of the corporation, what happens in the event of somebody's death. So it's very important that you understand the legal distinction between an individual and a corporation. Even where you are the sole shareholder of a corporation, you do not own the things in that corporation. You own shares of the corporation. You may own 100% of the shares of the corporation, but you own shares. So if you die still owning those shares, if the shares were bequeathed to somebody and they're transferred quickly, then any income, any tax, any responsibilities of that corporation become the responsibility of the person who had inherited the shares. If the shares aren't transferred to somebody else, then your estate would earn any income or dividends, interest or dividends from those shares, or maybe even have a capital gain if the corporation, let's say, were sold at any point. I think I'd like to talk now about inventory, because a lot of people wrote about that. So as many of you are aware, artists are probably only entities, the only type of business in Canada that's permitted to value their inventory at nil. And that is beneficial for many, in many ways. So it means, for instance, if you were, the way that we create inventory is when we make something, when a business makes something. So if you were a hat maker, the cost of buying all the materials and the labor to go into making that hat would be gathered together, and that would be the value of your inventory until it was sold. At which point those costs that went into making those hats, and you can substitute painting or sculpture or anything else in here, those costs would be used to offset that income. Because hat makers and widget makers and etc. often spend a lot of money in the manufacturing process and don't sell those items until a year or two down the road, the cost of producing the goods may not be a write-off the year that it's spent. You would, because you're holding inventory, both finished and unfinished in terms of supplies, you wouldn't claim the costs of producing those goods until the goods were sold. In the case of artists, and all arts, but particularly visual artists and sculptors, there has long been a policy of allowing artists to claim all of their expenses in the year they're spent. So you have many artists who have very high, what we call costs of goods sold. So the cost of painting supplies and helpers, people who produce large artwork often hire other people to help them produce it. And the same with writers who spend a lot of money in a research and development stage prior to producing a final piece for publication. All of those people ordinarily write off all of their costs and may have years where they show a loss on their income tax return because the sales don't happen till down the road. Doing that, and once you've made the decision to either write everything off the year you spend it or not write off everything, but keep a tally of those things and keep track of inventory, once you've made that decision, it sticks. You can't go back and forth. You have to continue using the method that you have chosen. So what happens to your inventory when a person dies? So if you have always chosen the nil inventory, nothing happens. You would, when you die, whatever expenses you had that year and whatever whatever sales you had that year figure into your income tax return, and the work that you produce that's sitting there has a nil value because you have not kept track of inventory in that way, which means that those works of art can then be transferred directly to a beneficiary at nil value. What happens for the beneficiary is, it means they're acquiring a piece of work at nil value. They might just hang it in their home and enjoy it for the rest of their life, but they may also wish to sell it. If the beneficiary sells it, they're acquiring something at nil value. So whatever they sell will be 100% of the sale price will be a capital gain for them, but not for the estate. On the other hand, if this is true for work that's owned by a deceased person, as long as it's either sold or transferred to a beneficiary in the first year after death. If it takes longer than that, then any sale is considered straight income. And as I'm assuming many of you know, regular income is taxed at a higher rate than capital gains are. So you have to be careful about that. I think that covered the inventory questions. I know other people had questions about income. after death. So an estate can continue to earn income like royalties or have sales after death. And there's two rules that you may be caught up in with this. One is this rule I just spoke about. That is that works of art have to be sold or transferred within the first year in order to have a tax beneficial status. But beyond that, if the estate continues to have income, royalties, or whatever, after 3 years, you end up being subject to a higher rate of tax. So it's to your great benefit to come up with a very good estate plan, which you would normally do with a lawyer, so that you can decide how those things would happen. I remember somebody wrote in and asked about destroying their work. I don't know why anybody would want to do that, although I inherited a piece of artwork from my mother-in-law, who was both a visual artist and a collector, that I would really love to destroy because it's the ugliest thing I've ever seen. Anyhow, I would think that destroying artwork would have no tax consequence unless that person had been using the inventory model. And if you were, I just, in 40 years of practice, I've not known any artists who use the inventory model. So that's why I don't talk about it very much. But if there was somebody who used it, and they had inventory and destroyed it, there would be a question about, would that create a tax loss? And since I've never seen it tested, I don't know that there's an actual verifiable answer, but my guess is it would not create a tax loss, because a tax loss can only happen if you actually try and sell something or it's unsellable. And if you sell it below value, below its cost value, or you can't sell it, which is definitely the case of the painting that I inherited. And if you willfully destroy it, then you've prevented any sale. So I think it would have no tax effect. There was another comment. Somebody asked about what happens if you declare your...
Can I jump in for a moment, Zoe? Because we've had a question on the inventory, and I wanted to jump in with this question before we get on to another topic, and that is to do with writers. And one writer says that inventory for a writer, or at least the cost of goods sold for a writer, is basically labor, unless they are, as you say, hiring researchers, that sort of thing. How is that labor factored into the cost versus the sale of the work or the royalties of the production? Okay, so first of all, that's not true. Inventory for a writer would be books. If you were self-published, you might have copies of books in inventory. Labor is not part of an author's inventory because one cannot claim the cost of their own labor ever. And let's say you were paying researchers to work with you on producing that book. That would probably just be an expense you'd write off in the year. So I mean, I have a number of clients who are self-published, mainly because of the way the publishing industry has changed over the years. So they used to have publishers and now they don't, so they have to do it themselves. These are people who may have boxes of books in their basement, and that's the inventory. And we know what the value of it is because we know how much they pay the printing press to produce those books. All right. Thank you for that.
So moving on to the question about declaring a last year of business. This is sort of an individual can't really declare a last year of business. I mean, you could. How would you declare it? there might be a question on the tax form that says, is this your last year? But it's a relatively meaningless question. A corporation, there's two issues though that I can see with it. A corporation, if it declares a final year of business and the corporation shuts down, that corporation cannot have any other income. So any sales, because the assets owned by that corporation would have had to be sold to somebody, the shareholder or whoever. So that's who would have the income. But an individual, the problem I can see is somebody who had an HST number. So you for all intents and purposes, stop business because you're not earning anything, and so you're not reporting it on your income tax return, and you shut down your HST number, but then you have a sale or two, and maybe it's significant. Like, I mean, if it was for HST purposes, if the sales in a given 4 quarters were over 30,000, that would be significant. If that happens, you would need to contact the Canada Revenue, and you would need to reactivate your HST number, because yes, you would be required to charge HST on those sales. And if you never had an HST number and your sales were over 30,000, you would be required to get an HST number and charge HST on those sales. Even if it's a one-time thing, you would make the sales, charge the HST, file the HST return and the tax return, and then shut it down again. Or you would just keep it open and file nil returns every year until such time as a sale was made and you needed it. So somebody asked the very general question, or what are common mistakes that people make, specifically artists. In the 40 years that my practice has been around, the two biggest mistakes I see people make are not filing their tax returns and or filing late. And that I'll include the HST along with tax in that, and not keeping good records. That's the second thing. And records doesn't have to be anything fancy. There is no rule about it. You really need to keep track of the income you earn and the expenses you have. That's it. And you need to do that on a year-by-year basis. Let's move on to valuation of work.
Before we do that,
Yeah.
A follow-up question. Would an estate have to register for HST or GST, depending on the province, if inventory sold is over $30,000?
Yes, absolutely. And I can tell you, so sometimes it's not the estate, sometimes it's an individual. I'll give you an example. A long time ago, a client of mine, an elderly woman who was a medal maker, she actually designed the profile of the Queen that we used on our pennies for all of those years. So she was well known in artist circles and in medal maker circles, and we don't use pennies at all anymore. So that just tells you how old she was. After she died, she had no spouse or children. Her niece inherited everything. And rather than set up an elaborate estate, the niece just, she had all of the, I don't even know what they're called, the impressions, I guess, that you would send off to the company that then creates the medals out of those impressions. So she had the artwork I think this same woman also did a medal for the Pope when the Pope came to Canada to speak. So a lot of her work was in demand even long after she died. But what happened in her case is her niece inherited everything. She inherited the etchings, the designs, and she had to register for HST because when she made a sale, the sales were often of great value, and so were the costs to produce the work. And there's no difference between the niece in that case who inherited everything, who's now in the business of selling those goods, and an estate. So if there was no specific person inheriting and you kept an estate and the estate sold work and the estate sold work and it was more than $30,000 in sale, the estate would need an HST number.
Okay, got a couple of other questions on other topics. Does leaving work to beneficiaries in your will meet the requirement to transfer the work in the first year after death?
As long as it's given to them in the first year. So yeah, you can't just give money to you can't just give it, you can't give anything of a dead person's goods, including their works of art, unless it's specified in a will. So it first has to be specified in the will, and then you actually have to make the transfer.
Okay, couple of other questions. Does leaving work to, well, that's the first question. That's the question I just asked. Can you explain the difference between the estate and the person/beneficiary?
A person is a person who's living prior to them dying. After they die, if any part of them lives on financially speaking, like investments or works of art that haven't been given to other people, like beneficiaries, then an estate is created. The beneficiary is the person who the beneficiaries are the people who the living person who creates the will, that will goes into effect when they die, and the beneficiaries are the people the will says should get their money or their household effects or their works of art or their car or whatever it is they have. Is that clear? I hope so.
I hope so too. And I think this is a follow-up question. How do you prove that works of art have actually been transferred?
Well, how do you prove anything?
Very good question.
We in Canada operate essentially on an honor system. We file tax returns and they're just accepted by Canada Revenue until such time, and we're assumed to be following the laws, including the laws of wills and estates. And the only reason that you would need to prove it is if somebody were questioning it. So who could question that? The tax department could question what you put on a tax return. A beneficiary could question what you gave to another beneficiary. This is like way more common than the tax department questioning something. If you have multiple beneficiaries, you would be really wise to have things properly appraised, because it's definitely not unheard of for beneficiaries to complain that somebody else got something of more value than they did. Did I answer that?
I think so. What if you're bequeathing, this is another question, what if you're bequeathing your estate to an institution, for example, a museum?
So that was actually my next topic.
Okay, well, I'll quit bothering you then and let you get on with it.
Okay. So we talked about transferring things within the first year. Many transfers are made to family members or beneficiaries, but often people who have significant collections. This doesn't only apply to artists, it also applies to collectors of art. Although collectors of art don't have inventory valued at nil because they have a price they would have paid when they bought it. If you transfer everything to a museum or a charity of any kind, so museums are a form of charity, but there are lots of different types. If you have not been using the inventory model, so you're not keeping track of inventory, then the goods have a nil value. You're getting rid of them by transferring them. So there's no income, there's no tax event, but neither does the estate or the deceased person get a charitable receipt for the donation because it had nil value. And in order to get a charity receipt from a charity, you have to be giving them something of value. So I'll just spend 2 minutes talking about what it means to donate works of your own making to a charity in your lifetime, because this is really often handled incorrectly. As I just said, charities are required to receive something that has a value associated with it, and the value is what allows them to issue the charity receipt. So a living artist who donates a painting, let's say, to a charitable organization, let's say you donate something to, this is common, a silent auction. The charity receives value for that work because they auction it off and they know how much they received, and they'll issue a charitable receipt to you for the value of the work that was auctioned off. What's supposed to happen is the person who donated the work to the silent auction is supposed to record income for the same value as the charity receipt that they received for the donation, because they technically sold that piece of work to the charity and the charity collected that money back from the donor. Probably 80 to 90% of artists who donate things during their lifetime do not do this. And the reason is the artists themselves don't know they're supposed to do this. And the charities often are also not aware, or they're just not compliant. You can argue with me about this, but it's the way it's been for years. Charity, I'm actually on the board of directors of a charity and have been on other charities in the past. And when you donate something to charity for a tax receipt, you're supposed to first sell it to them, record the income, including tax if there is any, and then offset it with the charity tax receipt. Okay, so I hope that covered it. I think we have gotten to the end of my notes, and that is really here's a question that says, how can your friends and family benefit from visual art legacy after you die through tax planning? Well, it's not tax planning you need, it's estate planning. Because when you're planning your estate, you need to determine, do you want to donate those works of art to a museum or an art gallery where your friends and family can go see them? Or do you want to pass them as gifts or inheritance to your friends and family? I think that's the answer to that question.
And there's also a comment on what you were talking about before. This is why donating to charitable auctions is a terrible idea.
Well, it's not necessarily a terrible idea. It's just not financially beneficial. You may still want to support the charity. And I guess here we're really talking more about visual artists than other artists. You know, if you're a well-known, well-selling artist, you may need not just an estate planner, but you probably have an agent or a dealer who will have opinions about how you should be letting your works of art go, because usually they want to protect the value of it. And that's a whole different level of planning.
Are museums charities in all cases?
Yes, I think they are. I mean, you may find the odd private gallery, you know, a museum, yes, they're all public institutions. There are often galleries that feel like they should be charities, but they're not.
Okay. Another question. I donated my papers as a writer to a university and claimed the charitable receipt, but not the donation as income. Is this wrong?
Well, technically, yes, it's wrong, but nobody's going to find out about it.
Especially because the person who submitted that question submitted it anonymously.
Good. That's a
So-
really smart person.
Here's another response to the response about donating to a charitable auction. It is a terrible idea and very exploitive. This tax receipt thing should be changed.
Well, I agree. I actually agree. But the only way to make change is politically, not it's not through the tax department, who's just an arm of the government. You know, the tax department just carries out the laws that politicians pass. So maybe that is something that Canadian Artists Network or some other lobby group could take on.
I'll make a note of that and get right on it, Zoe.
Add it to your long list of responsibilities.
You know it. You mentioned one of the common mistakes people make is not filing taxes. It actually reminded me of a colleague I once worked with who was in a pretty famous, or well-known for Canadian anyway, sitcom. And he didn't file his taxes for years. And when he was asked why, he said, I didn't think they'd ever find me. Guess what?
Somebody at the tax department watched television?
Watched the show, and he ended up working for the tax department for the next several years, paying off his back taxes. So they'll always get you.
You know, one of the best museums I've ever been in was the Picasso Museum in Paris. And I really, really enjoyed it because this museum was a work of, the entire building and all the works in it were never sold and were given by Picasso to the French government in lieu of unpaid taxes.
Probably wouldn't accept it today, or at least maybe in France they would, but not here. Here's a question. If a creator belongs to a copyright collective or has intellectual property that will earn royalties or residuals after the creator's death, what recommendations do you have?
My recommendation is that that's no different than any of the other stuff we talked about, like whether it's whether you're earning it as part of a collective or whether you're earning it as an individual. You need to decide whether you're going to transfer that ownership, in this case, the piece of the collective that you own, whether it's going to be held by your estate or by a beneficiary. And that would be part of the thing you would plan. My guess is that it would be that the answer to that might differ for each person. It would depend on what kind of values we're talking about, what kind of family the person had, whether there was somebody who would take it on. You know, sometimes creators with long legacies, with lots of money, simply have to keep estates open because there's too many family members to equitably share in things, or they don't, or it could be as simple as they don't want their kids fighting over it.
And on that note, I think we're going to wrap things up, Zoe. Thank you so much for your time today.
Thank you for inviting me.
Oh, our pleasure. Hope you'll come back again.
Absolutely. Maybe one day we can meet up in person again. Who knows?
Well, maybe you and I could because we're in the same city, but for the
Right.
folks.
I guess one of the things that the pandemic has allowed us to do is broaden our reach, and that's not a bad thing.
And that's why we were able to reach Happy Valley Goose Bay and Gabriola Island and Dallas, Texas today.
And I would go to any of those places in person if invited.
Okay, duly noted.
Okay.
Thank you again, Zoe.
Okay. Bye.
Bye-bye. You take care. Zoe Klein. Everyone, thank you very much. Thank you to Zoe. Thank you also to our friends at Carfac, who were very, very instrumental in making this whole series possible. We also want to thank Patrick Close for his advice on framing the topics of the entire series. Patrick, not only very closely associated with CARFAC, but he is also a member of the board of the Canadian Artists Network. If you were frantically writing down and taking notes and trying to keep up with what Zoe had to say, don't worry, because we're going to be posting a video of today's webinar online, probably early next week. So you'll be able to refresh your memory on anything you may have missed along the way. So thank you to everybody who made this possible. Thank you to all the arts organizations that publicize this to make it possible, to let everybody know. And most of all, thank you for joining us, because heck, without you, this whole thing would have been pointless. So we leave you with the final words of thank you. Have a creative day. Take care. Be well. And we'll talk again soon.